It's almost 11 a.m. in Hong Kong and 1 p.m. in Sydney. Welcome to Bloomberg Markets Asia. I'm Paul Allen. Here are the top stories. Asian stocks shrug off positive cues from Wall Street as a double whammy of US inflation data and the Fed decision keeps traders on edge. China's consumer prices rose in May, holding above zero for a fourth month, but factory gate prices still stuck in deflation. And the rupee on watch after a record closing low against the dollar. We'll take a closer look at how the currency's weakness impacts inflation and RBI policy. But first up, let's take a look at how markets are tracking around the region. Avril Hong's keeping an eye on things in Singapore. Avril.
Yeah, Paul, we're seeing it mostly risk off this part of the world as investors shrug off a mostly positive U.S. session amid those lower U.S. yields and a strong Treasury auction for 10-year notes that saw the highest bid-to-cover ratio since those rate hikes began. The Kospi is a bit of an outlier today. It's boosted by the Apple suppliers after the U.S. tech giant surged to a record, a bit of a delayed response to its AI event. The Hang Seng is leading the declines in the region. CSI 300, we're keeping a watch on it as well, because yesterday it closed at 6-week lows. A bit of recovery on the offshore yuan that is hovering near the weakest level so far this year. Now, we did get data out of China. Let's flip the board and take you there, where the consumer price gains, they are sitting above zero, but they came in lower than estimates. On the PPI front, it shows that factory gate deflation narrowing, but as our colleagues at Bloomberg Economics have been pointing out, this is due to base effects. The takeaway is that demand is still weak domestically in China. Let's flip the board because we're also keeping an eye out on those US CPI numbers, and they come right smack in the middle of a two-day policy meeting from the Federal Reserve. A disappointing number is almost surely going to cause investors to pare back their rate cut expectations, especially in the wake of last week's blowout jobs report. This is what swaps traders are pricing in for now. Paul.
All right, thanks very much, Avril. Our next guest says his long-term advice is to buy equities, but only after or when the Fed cuts. Let's bring in Andrew Freris, CEO of Econosis Advisory. Andrew, let's start off with that call right away. I mean, it seems almost counterintuitive, doesn't it? You'd miss out on some potential gains. What's your rationale here?
Well, very, very simple, actually. For the last 12 months, all we have been having is yes, they are cutting, no, they are not cutting, yes, they're cutting, no, they are not cutting. And all of these are based on a set of inflation numbers that are completely trendless. So in other words, it's become impossible to even guess, never mind forecast what the Fed will do. So my advice is, since it's going to be bullish when interest rates are coming down, and since there is no way we're going to be able to predict that, lay back, you're going to miss the big whoomp when the interest rates are finally cut, but do it when it does happen. In other words, it has been literally a nerve-wracking overall experience. In between, there's something else you can be making money out of, and that is, since I don't expect that anything is going to happen to interest rates between now and Christmas, you have 6 months of very high yields. Use them. And if you are long on US government bonds, then when the interest rates are cut, prices are going to go up, you'll make the capital gains. Very straightforward, really realistic stuff. Mickey Mouse 101 investment, but I think it works.
Mm-hmm. All right, I want to come back to some of your calls a little bit later, but just to reinforce your point, we do have a chart here on the Bloomberg which indicates that, well, the market's now pricing in just 1.5 cuts this year, and to your point, it's not that long ago that we were expecting 5, 6, a fairly aggressive easing cycle. Now, we've got the CPI numbers out of the US while the Fed meeting is in progress. Do you expect further repricing if the CPI ends up being sticky? What are the chances of that happening?
No, actually, nothing is going to happen because, for example, the CPE, which is the favorite one of Fed, has actually been accelerating, has been increasing faster. And the CPI, which is presumably is not really the one that we want, if you simply take the number 3, which is, of course, the wrong number, we want a number 2 there, not a number 3, and then you look at the decimals, they're completely all over the place. In the first 4 months of this year, it has been 3.1, 3.5, 3.2. In other words, it's trendless. So never mind falling below the 3. Remember, the Fed is gunning for 2. Hello? So, so my advice again is to my clients, whatever is the CPI number tomorrow, please ignore it. We will need at least 3 or 4 consistently falling CPI numbers, and we are not getting them at all, okay, before the Fed begins to say, well, we're sort of getting there. The new 2 is number 3. There is, I'm coining a phrase, and the fact that the decimal parts after that are coming down, it shows that the trend is falling, and that's what we want. That's not what they're getting.
Well,
not a long stretch.
Look, there's another big macro event on the horizon, of course, is the US presidential election. Now, look, regardless of who wins, what do you expect in terms of fiscal policy, and could we see inflation making a comeback in 2025?
Both of them are going to increase the fiscal deficit. There is not a threat about that. But unfortunately, Trump is going to hit the events button much harder than Biden would be. And for example, if it is true that he really means 60% increase 60% tariff on all imports from China and a 10% tariff on imports from everybody else, this is what I mean by a big event. And of course, increases in taxes always are passed on to consumers, and therefore that will be bad for inflation. So straight away, if Trump does what he says he's going to do and gets elected, the immediate impact will likely to be not only inflationary expectations, but actually CPI going up.
Oh, well, you mentioned you liked bonds. I'm just wondering where you think yields are headed after this Fed meeting is done and dusted, and connected with your view on, only buy equities when the Fed does start easing and some of the disappointments that we've talked about over the past 6 months. Where do you see the S&P by year end?
I'm afraid I have to reluctantly say flat. So in other words, rather than give you an actual number, it has been doing quite well throughout the year. But remember, with a lot of moaning and gnashing of teeth, it has not been an easy ride. So I don't think that we're going to hit the elections with no with no movements in interest rates. And we may very well get a surprise election, and that is Trump. Hardly surprised, but it would be, with an economic agenda which is both untested and to some extent wild, and therefore I'm not going to be equally happy that the S&P were not going to give up some of the gains.
All right, so how are you trading around that election risk?
Making a list, in fact, of what I should or should not buy if any of the two are elected. For example, if Biden is elected, that's in general relatively negative for anything that has to do with the carbon sector. In other words, oil, mining, and the big power companies, because he does have and continues to have a climate policy. Trump doesn't. Trump has actually said he's going to move away from the COP15, the United Nations Agreement on climate. So that's going to be bullish for the carbon sector. So unfortunately, I have two extremes. So in other words, I will tell you, if you're going to buy energy, buy it if you really think that Trump is going to get elected. If not, don't buy it. So I'm afraid I have both a negative and a positive catalog. I don't really have got a balance sheet whereby if Trump gets elected or if Biden gets elected, then that is going to be very good for the equities. It's going to be quite mixed because my list contains as many don't buy and do buy, whether anyone is elected. Whether any one of them is actually the winner. Sorry, I sound like an economist.
You mentioned you like...
I'm afraid it would be rather stupid and risky to tell you if, please, from now on, sort of load up on equities, whichever happens to be the winner. Or whomever happens.
Now, I know you do like defence stocks. Does that apply to whoever becomes the winner as well? And are you trying to tell us something about your outlook here for geopolitics?
Absolutely. Unfortunately, without gloating, because I'm very aware, I'm asking people to buy into companies that produce goods, in inverted commas, that kill people. Yeah, that's what it is. It's blunt. But, and that's a big but. Morality aside or amorality aside, okay, the Ukraine war is not going to be end. We have no idea what's going to happen with Gaza, and all major and minor economies in the G20 are beginning to spend as if there is no tomorrow, and that's good for defense. Unfortunately, it's a sad thing to say, but this is an almost guarantee by whether Trump or whether Biden is elected. More money on defense goods, absolutely.
Yeah, and of course you mentioned Ukraine there. That there is also a backdrop of some tension with China, certainly vis-a-vis Taiwan as well. But if we step back from that and take a look at the Chinese economy more broadly, I mean, we've had another set of rather tepid CPI numbers in the last little while. Consumer confidence isn't that good. What's your view of the Chinese economy going forward?
Actually, an economy which has been growing at about 5%, if one says, well, it's not doing very well, you'll say, hang on a minute, really? What do you want it to happen? The key issue with the Chinese economy right now, it's a duplex of deflationary processes. One is, of course, what's happening in the property market, which is not reflected directly in the CPI. And secondly, what's happening on the CPI and PPI, both of which have been either zero to flat, or in the case of the PPI, absolutely negative. Now, look at this. China seems to be doing what the rest of the world is absolutely begging to do, and that is to have very low inflation and high growth. Ta-da! They actually have it. So a man from Mars looking at the Fed and looking at the People's Bank of China will say, hang on a minute, these guys are not doing too badly. However, and that's a big however, this is not reflected on the stock index, which is absolutely correct and true, because stock indexes don't necessarily reflect GDP growth. We know that. They reflect all kinds of a combination of expectations, over policies, over politics, and of course, in the case of China, is the still unnerving fact that the property sector just will not go away. My favorite index of property, the prices of newly built properties in 70 major cities in China, has been going down, negatively shrinking for the last, take a deep breath, 2 years. Now, how do I reconcile that with a 5% growth? And the answer is yes, you're having an economy which is growing quite strongly, but the pricing of goods and services is not. Is that a good thing? Is that a bad thing? As long as it does not affect massively expectations when it comes to investment, then I would say, my God, the Chinese have got it both ways. Not a Goldilocks economy, a perfect economy. They are growing quite well, and they don't have inflation.
Well, if on the one hand you are impressed by China's growth rate, and it does remain impressive compared globally, are you impressed by the equity market in terms of being impressed enough to buy? Because it's very cheap at the moment.
No, actually, buying the Chinese equity market will become a strong buy when there is clear evidence that the prices in the property sector have stopped falling. And this hasn't happened. And the authorities have had a lot of issues and a lot of problems in pumping more money into the property sector. Now, taking simply the expectational aspect, it is rather upsetting, I would imagine, for the Chinese authorities that the GDP economy, the GDP part of the economy is doing very well, but the equities are not. And the reason for that is primarily expectational, and they are related to the deflation, which, it's very awkward, but unfortunately, we appear not to be able to have it both ways when it comes to actually buying the equity market in China. I would be a big buyer of the equity market in China when there is a clear evidence that the deflationary process has slowed down or has flattened out. It might be a little bit misleading because the CPI is not growing negatively. The one which is growing negatively is the PPI.
Yeah. All right, Andrew Freris, we're unfortunately out of time, but thank you so much for joining us. Andrew Freris is CEO of Ecognosis Advisory. Still to come this hour, we're going to be speaking with the CEO of the US National Retail Federation about opportunities in the retail sector in Asia and beyond. And we'll preview India's upcoming economic data releases with Quant Eco Research. First though, Australian Treasurer Jim Chalmers says he's not expecting the economy to experience another bout of stagflation. Our exclusive interview next. This is Bloomberg. All right, let's take a look at how we're doing here in Australia. We've got another down day on the ASX at the moment, off about 0.5%. And most sectors in negative territory. It's just the energy sector that's performing well, really. That's up by about 1.2%. We've got a bit of a bounce in the oil price as well. The Aussie dollar holding there at about 66 cents. And we're seeing not a great deal of change in yields either. We are, of course, counting down to a Reserve Bank of Australia meeting that's taking place next week. Australian Treasurer Jim Chalmers, meanwhile, downplaying the possibility of stagflation in Australia's economy. And that's despite sluggish growth in the first quarter and stubborn inflation. He spoke to us exclusively from the Morgan Stanley Australia Summit.
We do have a remarkably resilient labour market still, and that's one of the big differences here. We'll learn more about our labour market tomorrow when we get our labour force data. We have had slower growth, but we've had inflation moderating to almost half what it was 2 years ago, less than half what it was at its peak. So we've got moderating inflation, we've got a resilient labour market, we've got relatively weak growth, and in all of these circumstances it was really important in our budget that we carefully calibrated our fiscal settings to respond to those economic conditions and those economic challenges. And I'm confident but not complacent that we can achieve a soft landing here in Australia on that narrow runway that our Reserve Bank Governor has described.
It's going to be a busy weekend with the Chinese Premier's visit. What are the economic stakes for Australia?
Obviously, this is an incredibly important economic relationship for Australia. And Premier Lee's visit will be a really welcome opportunity for us to continue to engage, to continue to stabilise a relationship which has no shortage of challenges and complexities. It can be a complex relationship to manage, but what we've shown, I think, in the last 2 years is that by engaging, by standing up for our interests when it's necessary to do so, but also looking for ways to engage and stabilise the relationship, there can be good economic dividends from that. We're very pleased to see almost all of the trade restrictions lifted over the past couple of years. That's important for our employers and our industries and our exporters. We recognise and understand how important that economic relationship is, and Premier Lee's visit will be an opportunity to advance that even further.
We were talking about the inflation numbers for China, and obviously for Australia we're closely watching the developments when it comes to the economic recovery. What we hope is an economic recovery. Do you think the recovery is on foot? Do you think the property sector is at least out of structural levels of direness that we've seen, and do you think that translates to still a longer term demand for Australian commodities?
Well, certainly we've acknowledged and understood and felt some of the weakness in the Chinese economy in recent times, recent quarters. And that won't fix itself overnight. Even with some of the interventions by the authorities, we're still seeing some underlying weakness in the Chinese economy, and that does impact on our commodity prices and on our economy more broadly. So we watch that very closely.
Australian Treasurer Jim Chalmers there, speaking exclusively with Bloomberg's Heidi Straub-Watts. Plenty more ahead. This is Bloomberg. The Hong Kong insider trading case against Saganti Capital Management and its founder Simon Sadler is being transferred to a higher court. Bloomberg's Min Min Loh joins us now from outside the city's Eastern Magistrates Court. So Min Min, what can you tell us about what happened today?
Yeah, the defendants had appeared in person in court today. We just saw Simon Sadler as well as Daniel LaRocca walk out of the courthouse separately just about half an hour ago. It was a very short hearing. The court is going to move this case up to the district court on July 2nd at 10:15 a.m. Now, what's significant about this is that the district court will be able to hand out longer sentences of up to 7 years, which is higher than what the magistrates court can hand out up to 3 years in prison. That's still lower than the maximum penalty for insider trading, though. The maximum penalty is 10 years in prison. The two defendants, Simon Sadler as well as Daniel LaRocca, they had not entered a plea the last time they appeared in court in early May. This time they're extending their bail on the same conditions, which was $1 million Hong Kong dollars for Simon Sadler and $500,000 for Daniel LaRocca. Now, the two defendants, interestingly, they were not sitting together in the courthouse. They also came and left separately as well. There's not a lot we can report today because there was no trial, no verdict. We'll have to wait for the next hearing to see what happens.
Okay, so no verdict, obviously, but did we get any more details on the charges that we heard from the hearing today?
Yeah, we did. There were a lot more details that were disclosed in the court documents. So Sagenti had apparently traded over, they had sold more than $1.5 million, they have sold more than 1.5 million shares that they already own of Esprit back in June 2017. And separately, they had also short sold about 130,000 shares of Esprit. That's ahead of a block trade that was carried out in June 2017. So in total, they had sold over $1 million worth of Esprit's share. It was done through Sagenti's own trading account as well as through UBS Securities. And they had gotten an insider tip from a man named Tony Sorianos. This man was working for Bank of America's Merrill Lynch back in 2017, but Merrill Lynch was not named in the court documents. So the arguments around this case will really center on how much information was shared with Sagenti before the block trade, whether they knew of the scale of the block trade and whether they had acted on this non-public market-moving information. And according to our Bloomberg terminal data as well, we did see unusual price movements on Esprit's shares ahead of the block trade in June 2017. In the 2 days ahead of the trade, shares had fallen by 3% per day. And on the day of the block trade, it had plummeted 13%. And in all, Esprit had lost nearly 30% of its share value in 6 consecutive days of trading.
All right, China reporter Min Lo there outside the Hong Kong Eastern Magistrate Court. Okay, let's take a look at some of the news that we're getting out of China at the moment. And SocGen got a call from them turning positive on China or overweight on Chinese stocks. This is the first time since December 2022, citing positive policy momentum there, improvement in earnings outlook as well. SocGen saying it does still prefer offshore and large stocks, those tied to themes like resilient earnings and stable dividends as well. Still to come on Bloomberg Markets Asia, the CEO of the US National Retail Federation going to join us, share their outlook for the global retail sector. We discuss key risks for the industry as well. That's up next. This is Bloomberg. Welcome back. We've got markets in China just on their way to lunch. It's another down day for Chinese equities, not severely so though. We've got the CSI 300 off there by a shade under 0.1%. We did, of course, have a rather weak CPI, PPI readout of China a little bit earlier. We'll discuss that in more detail in just a moment. Keeping an eye on the yuan as well. That is continuing to close in on some of the weakest levels that we've seen this year. Well, aside from CPI, PPI out of China, it's been data-heavy day elsewhere as well. We had an inflation print out of Japan also. Avril's here with a closer look at that. Avril.
Yeah, Paul, we are anticipating the U.S. inflation numbers later today, but we got those Japan producer price numbers in the morning. And this is, to be clear, not a number that typically is a market mover, but this is BOJ week. So it is worth highlighting that we saw the PPI rising at the fastest clip in 9 months. It came in hotter than expected, and it showed a rise in the cost of import materials. And it seems to suggest how the weak yen is adding to these inflationary pressures in Japan. And let's also keep in mind that this is the first print where the successful wage result negotiations were actually reflected. All in seems to be adding to the case for the BOJ to tighten in support of the Japanese currency. So that's what we're seeing data-wise. Let's flip the board and take a look at what we're seeing in the FX space, because I think the dollar yen, it's not being helped along by these expectations of BOJ tightening later in the week or potentially even next month. It's really that eye that we're keeping out on for U.S. inflation numbers as well as the Fed. We have a decision due from the Bank of Thailand. It's expected to keep things unchanged, defying pressure from the government to ease, and that should be supportive of the Thai baht, keeping an eye on the rupee as well. Now pulling away from that fresh record low that we saw it hit just yesterday, and it's moving away from the 83.57 level. And of course, as we keep an eye out on the US data, we also are watching out for how the offshore yuan is faring. A bit of a recovery today, even against the backdrop of that China data poll.
All right, thanks very much, Avril. Well, I did mention China's consumer prices edging higher in May. Factory gate prices, though, remaining stuck in deflation, as they have been since 2022. So let's get more with Bloomberg economist Eric Zhu. Eric, what's your take on these numbers and more broadly the health of the Chinese economy?
I think it's basically meeting our expectations. So the CPI, is statistically out of deflation, but still very weak. It's just barely above zero. And if you look at details, actually the most positive contribution is from food prices. Outside food, actually the core inflation was even weaker than last month. So it's a clear signal that other than food, probably the underlying demand in the China economy is still very weak. And statistically, we are out of deflation, but it doesn't mean that deflationary pressure is gone. So we still need more policy support to, revive the demand, domestic demand in China.
So let's talk about factory gate prices. They're stuck in deflation. Do we have any signs at all suggesting there might be a turnaround in this?
Yeah, I think probably in the second half of the year, we're going to continue to see some, the narrowing of the deflation, and probably in the final quarter, we might see some positive reading on PPI. So again, it's somewhat related to the low base last year, but also if the global commodity prices see more rally, that will going to, contribute more to the PPI, help to bring that back into inflation.
So you've got a really fascinating report out today on consumer trends in China, from lipstick to lottery tickets. What have these items got in common?
Yeah, I think it started from observation that the lottery sales in China pick up very fast after pandemic, especially last year. But it's kind of puzzling because, before the pandemic, lottery sales used to grow together with income. But obviously, after pandemic, the people in China, they saw a slower income growth. So that makes us think that probably it is now a consumer preference shift in the lottery sales. Especially we think that the players of lottery now probably shifting to those younger, more educated population, but who are frustrated by the job and income outlook. So that probably explains why the low confidence in China is driving the lottery sales. And interestingly, we also see that the marriage rates, so if we use that as a proxy for the young people confidence for the future, we see a very clear pattern that those provinces who see a faster lottery growth, actually they also see a lower marriage rates at the same time. So that's suggesting that probably a low confidence among young people is driving both observations we see from China right now.
All right, Bloomberg Economics' Eric Zhu there. Well, let's take a look ahead to the US CPI print. Our next guest says the pressure is going to be on services, which makes up a large part of the consumer index. Let's bring in Matthew Shea now. He's president and CEO of the US National Retail Federation, and that's the world's largest retail trade association. Matt, thanks so much for joining us. I do want to kick off with that US CPI number. It's being very closely watched by traders at the moment. I'm just wondering what your outlook is for inflation, how that could potentially impact US consumer behavior.
Yeah, well, Paul, good afternoon, and happy to be with you to talk about this as we're here in Singapore this week for our own events, and we could talk about that later too. I think, first of all, the Fed is meeting this week. No one expects the Fed to do anything beyond what we're all doing, which is watch the data. The Fed's not going to raise rates. They're not going to lower rates this week. We're all watching CPI. The Fed really watches more closely the PCE numbers in the U.S. Those don't come out for almost 3 more weeks, till June 28th. The thing that we're going to see in CPI is that because 70% of CPI really is composed of services indicators, that's why it's been running pretty hot, because in the U.S. economy, that's where all the inflation is. Goods inflation has been flat to negative. So there's really not much room for goods inflation to adjust any further than it already has. And it's really on the services side that we've got to see how we can bring that down. And in the face of that, to the point of your question, consumers continue to be pretty resilient. Consumers are out shopping, spending, they're engaged in commerce, and that is primarily because the employment numbers are very solid and very healthy, and because wage gains continue to outpace inflation in the U.S. for the average U.S. worker. So as long as people are employed in the U.S., as long as their wages exceed inflation, they'll continue to shop. They're not very happy about inflation. We know that very clearly, that consumers all feel the pain of inflation. But at the moment, we've seen maybe a little moderation, but not very much softening in consumer behavior.
Yeah, the consumer has been surprisingly resilient, but of course high inflation means rates are higher for longer. Are any of your members finding rates particularly burdensome? How's it affecting the bricks and mortar retail stores?
Yeah, I think what you see, Paul, and then in the U.S. is a continued, maybe accelerated and more pronounced bifurcation of income levels behaving differently. So at the higher income levels, those consumers are still engaged in travel and tourism, hospitality, engaged with luxury brands, shopping and traveling, whereas the average U.S. household that's got maybe a $60,000 a year annual income is finding it much more challenging, because energy prices are higher, because rent and housing prices are higher. The things on the services side are really driving price increases. Retailers, especially in the supermarket space, in general merchandise, in warehouse, club stores, are really delivering great value right now, and in fact are delivering lower prices now than even over the last couple of years. So retailers are working very hard to try to meet the demands of consumers. However, it's clear that some households in the U.S. are much more pressured than others because their monthly income doesn't go as far as it used to. They're paying more for housing, more for rent, more for other services, more for auto insurance, and then more for energy prices, for gasoline and other energy costs. So that's creating real pressure on those lower income and average income households, and the higher income households in relative terms are still behaving reasonably aggressively.
Yeah, well, the economic data aside, I want to talk about some of the political risks as well, because, of course, a lot of the goods available in the US come from China. Is the current tension between US and China affecting business at all? And I'm thinking particularly in terms around forced labor, copyright theft, pollution, and other issues.
Those are all critically important issues for retailers, and our members and other businesses in the U.S. are very attuned to that. because it impacts their business. It's certainly the right thing to do, to be addressing those issues and identifying suppliers and supply chains and partners in these markets to ensure there's great transparency and there's adherence to the rule of law and respect for people's human rights. And so those things, I think, are all happening. And because retailers are in a consumer-facing business, so their customers are paying great attention to this. And as a result, retailers do as well. I'd say in spite of the tensions that exist at the political level, you see when business leaders from this region and from the U.S. make visits to Asia, to China, to the mainland, it's still an incredibly important market, both as a consumer market as well as a market for sourcing and supply. It's too big a market not to be engaged with, and so you continue to see CEOs make the visits, make the trips, make the investments. And on the supply chain side in particular, there are some goods that, because of the availability of natural resources and the sophistication of the production facilities, that as much as you see diversification in the supply chain, some elements of the supply chain, some particular products are going to continue to be manufactured in China, no matter what, because it's cost effective to do that and because it'd be too burdensome to make a move. So I think in the U.S. we're trying to balance both of those things. Politically, there's great concern about the relationship and maintaining stability. Economically, there's a recognition that China is an essential partner and will continue to be in the foreseeable future.
A lot of online products, of course, get shipped to the U.S. from China in very small packages, and this way getting around tariffs. Do you think there needs to be some policy in this area to address that?
Well, in the U.S., there's a rule called the de minimis rule, which permits the importation of goods with a value below $800 without the imposition of taxes or tariffs. And, that rule made sense when it was implemented. It creates an environment now where there's an incentive for manufacturers and suppliers and retailers outside the U.S. To send things into the U.S. and ship direct to consumers and avoid paying the tax. And you've got, obviously, retailers in the U.S. that are not able to do that because they're selling through stores and other U.S.-based distribution points, and they're subject to taxes and tariffs. So there needs to be some leveling there, some consistency created. It's challenging because you could continue to reduce the threshold from $800 U.S. dollars to $500 to $250 to $100. You almost can't get it low enough to avoid the importation of some goods. And I think, one of the reasons we've seen this is because we've seen manufacturers get so good at this outside the U.S. and because the supply chains are so efficient. So that clearly needs work. There's not an easy solution, but we're certainly engaged in conversations with everyone to try to find one.
Matthew, just quickly, because we're nearly out of time, but before we let you go, you're joining us from there in Singapore from the NEF APAC conference. I'm just wondering if you're seeing any opportunities there in the Asia Pacific.
We are. It's the fastest growing market. It's the most diverse market. We've got tens of millions of consumers here and potential customers. So this is a great place for the NRF to be hosting an event, convening hundreds of exhibitors, thousands of attendees. This week we actually sold out, and we'll be back again next year, June 3rd to 5th. So we're excited for the partnership here and look forward to being back again next year and many years in the future.
All right, good stuff. Matthew Shea, President and CEO of National Retail Federation. Thank you so much for joining us. Still to come, we're going to preview India's upcoming economic releases with Quant Eco Research and hear why they think core inflation could trend higher in the next few months. This is Bloomberg. All right, welcome back. You're watching the India Focus just in time for the open of trading in India. Looks like a modestly risk-on day in the early going. We've got most of the major indexes up there by about 0.25%. Keeping a close eye on the rupee at the bottom of your screen there. It's just reversing away from those record lows versus the greenback, but we'll be watching that very closely today. Also watching closely, India is going to be releasing data on inflation, industrial production and trade this week. Bloomberg Economics expects inflation to hold steady in May, with food costs continuing to be the driver. Now let's get some perspective on this from Shubhita Rao, founder of Quant Eco Research. Shubhita, thank you so much for joining us. We will get those CPI numbers in a few hours' time, expected to edge up just 2 basis points to 4.85%. But inflation, like in many countries, still proving sticky. What's keeping it elevated in India?
Thanks, Paul. Good afternoon. This evening's print in India later today what keeps the consumer inflation pretty much in a range-bound manner. Our own consensus is much higher than consensus. We are at a 5.14, essentially being driven, as you rightly pointed out, by the food prices. We've had not a great monsoon season last year. This year, the monsoon season is expected to be much better. It has been a timely arrival. Food prices have remained elevated through most of the last 6 months, driving the headline inflation up. And this evening, probably what we could see is a repetition of the same story. While the core inflation, that is cutting off the fuel and food prices, remains at record low, around 3%, it's essentially the food prices driven by perishables, which are actually driving the headline CPI higher. This could prevail over the next 2 to 3 months, we believe. But thereafter, with a monsoon coverage over the entire subcontinent, we expect prices to cool off and mostly converge closer to 4.5 for the year.
The growth story in India still looks very, very strong, but we've got industrial production expected to slow a little bit in April. Is there anything in this number that concerns you?
Actually, the lopsidedness in terms of the details of industrial production. Mind you, over the last 10 to 11 years, the year that we closed for fiscal 24 actually recorded one of the best numbers in terms of industrial production growth, if you leave out the COVID distortions. But having said, there has been an unevenness in growth. Investment-related industrial production continues to push the headline closer to around 5% or thereabouts. But importantly, and a larger concern emanates from the consumption-related items within the industrial production basket. Those worry us because both on the non-durables consumption as well as on the durables consumption space, we do see softness persisting. And so long as we have lower employment growth, the monsoon impact yet to be felt in the country, I think we could continue to see the same story repeat over the next 2-3 months. But a lot depends on the budget that will be announced by the newly elected government in the month of July. And we hope to see some traction coming therein later on in terms of giving a better balance in industrial production story.
Yeah, let's talk a little bit about the budget because, of course, the Finance Minister, Nirmala Sitharaman, being reappointed, so there's some continuity, some certainty there for markets. But do you anticipate any surprises in that budget, or particularly around taxation?
I would not really think that the final budget would be anything dramatically different from what was presented in February as an interim budget. Perhaps internally we could see small adjustments towards allocation of expenditures, gearing more towards the rural economy, towards the less privileged population. There could be higher allocations to that. But in totality, if we look at the broad headline numbers in terms of the fiscal consolidation, in terms of the tax collections, remember India's tax buoyancy has been steadily improving. The overall economic momentum has been supporting tax collections very smartly. Add to that the recent, a very strong surprise number on the central bank's dividend to the government, almost double the market expectations, provides a fair bit of cushion to the government to engage in some retweaking of some of the expenditure numbers. But we do believe that overall, the fiscal consolidation number of 5.1% to GDP would probably be maintained in the final budget to be presented in around mid-July.
Just as you're speaking there, we do see the Indian rupee tracking next year. It's near record lows. I'm just wondering what your expectations are around that and the RBI's FX toolkit.
No, that's a great question, Paul, because largely a lot of market participants are expecting rupee to actually appreciate in the course of next 10 to 12 months. We are in the contrarian camp. We believe that rupee has a depreciating bias, not essentially because of the fundamentals, because on our external account, India is not expected to do any worse. In fact, we are going to be perhaps posting a very manageable current account gap, that is current account deficit, close to about 1% of GDP, extremely manageable given the kind of capital flows that we anticipate in India to come in both through equity and debt flows. Having said, it would be more governed by what the monetary policies across the globe, mainly Fed, how India would respond to that. We expect RBI to start easing policy rates only by October, not earlier. And importantly, what China also does in terms of fixing its currency.
Shubhita, we are out of time, unfortunately, but thank you so much for joining us. Shubhita Rao is founder of Quant Eco Research. Let's just get a quick update out of Pakistan, because the government there is going to be unveiling its post-election budget later on Wednesday. That plan expected to outline targets for tax revenue growth, possible tax changes, the fiscal deficit as well. More to come. This is Bloomberg. Here are some of the top stories that we're watching from the corporate space. ByteDance said to be slashing about 450 jobs at its Indonesian e-commerce arm. It's the first round of cuts since combining its TikTok shop with local rival Tokopedia. Sources say the cuts to about 9% of staff are going to start as soon as this month. It signals ByteDance is seeking to reduce costs after January's $1.5 billion deal with Tokopedia. Oracle surged in extended trading after posting bookings well ahead of expectations. The results suggest growing momentum for Oracle's efforts to compete in cloud computing against larger rivals Amazon, Microsoft and Google. The firm also sees revenue growth increasing by double digits in the current fiscal year, fueled by stronger AI demand. And we'll be watching the Bank of Thailand rate decision in the coming hours. Most economists, including our team at Bloomberg Economics, expect the central bank to hold off on a cut, keeping the rate at a decade high. And this comes amid growing political uncertainty in the country, as well as intense pressure from the government to cut rates. That is it from Bloomberg Markets Asia. Horizons, Middle East and Africa up next. This is Bloomberg.